super funds underperform. They always have and they always will. And one of the main reasons that they underperform is that they're fundamental analysts, right? And I don't have a problem with fundamental analysts. I only have a problem because fundamental analysts believe, or at least they tell us they believe, that you can't time the market. And if you can't time the market, then if you have a portfolio and you get out of that portfolio, where are you going to get back in? Well, as you'll see from what we do tonight, that's not a problem. Getting back in is not a problem because all we have to do is determine what is a rising trend and get in when it's rising. And what we'll see is that it's not that difficult. I have 3 simple criteria. When the 3 simple criteria are met, and then we're happy to go into either funds or we're happy to actually start trading our own account. Okay, so I have a problem with fundamental analysis. And the media is part of the problem. How many technical analysts have you read in the newspaper lately or in magazines? You don't. You read about Warren Buffett. You read about the experts who work for the banks and who work for the brokers. And they're fundamental analysts. Because if they don't want you to know that you can time the market, because what do you need them for then? Good point. What do you need them for? The fact is we don't need them. We don't mind trading the same things that they trade. The problem with fundamental analysts, and they tell you, is that you can't get out or you can't time the market. So they'll tell you that that's a good place to get in. Or that if you were only over here, you should stay in because if you get out, you're not going to know where to get out. And obviously, this is better value than this. But they'll also tell you, don't spend all your money because it'll probably go down and you can buy some more at a less of a price. So now it's better value down here. And they tell you, well, look, you're much better off getting in down here. Except all of this is in a falling trend. They tell you because you can't time the market that this is what you have to do. It's called dollar cost averaging. It's a loser. There's been special research on it, and it doesn't work. What we want to do is take the same companies that the experts are trading in, and we want to buy them when they're rising market, when they meet 3 specific criteria that now they're in a rising trend. And after a falling trend, generally, this rising trend lasts for between 12 and 18 months. So we have lots of opportunities to get in. Lots of times that we can make money. And all the time that I talk about falling and rising trends tonight, it's not about saying this is what you could have done or should have done or would have done, because now the newsletter has been going for 7 years and I've done the study on my analysis going back to 1989. Which means that every time I said that there was a rising market or a falling market, there's a record of it in the newsletter. So I mean, we went back in the market on September of 2012. Okay, we were out from July of 11. We were in from June of 09. We were out from January of 08. Every one of those is recorded in the newsletter. So super funds underperform. They always have. They always will. Which is